Okay, welcome everybody to Wall Street Reporter's next Super Stock, a live stream, our first live stream for the new year for 2022. And we are starting off with one of the hottest health tech companies right now in the market, RQHTF, Reliq Health Technologies, and RHT in Toronto. Dr. Lisa, welcome back.
Thank you. Thanks, Jack. Thanks for having me back, and Happy New Year to everyone.
Absolutely. And for anybody that's brand new to our program, our goal is to bring you those stocks which have that 10x to 100x upside potential. So these are companies going after massive multi-billion-dollar market opportunities that are at a key inflection point and with multiple catalysts in place. And, we've had, so many of these stocks that have increased between 1,000% or more. And now it's, I think this 2022 could be Reliq's year. Reliq started with us last year, right? A little bit, I think it was 90 cents around. So the stock is getting close to making new highs right now. And it's actually, you've met all the criteria, the inflection point, the contract, everything started working. So I think last year was really, I would say it was definitely that inflection point where, you got all of a sudden, the contract started snowballing, there was market validation. And now this is the year where everything is really like people are going to see all the hard work that you've been, putting together. So before we get into the big news today, which everybody wants to know, which this is the thing that the market is excited about. One of the key things that probably everybody wants to know is what was the run rate that you exited December at? Did you?
It was $2 million a month, as we'd said it would be. So yeah,
Okay, so $2 million a month exit in per month run rate.
Yes.
Last 2020. Okay, so which basically right now, so the company right now is at a $24 million run rate annualized.
Yeah,
which is, that's substantial, in the health tech space. We know what kind of multiples are. Potential in theory, we've seen stocks trade at 50x revenues. We've seen that.
Yeah.
So in theory, Reliq could be trading at $1 billion run rate. Again, the market is forward looking. So you got the 24 million runner plus, people might price in even further out. So, and you got a little bit under 200 million shares out right now.
Yeah, about 190 million fully diluted.
So so in theory, the stock should be trading at $5, like literally as we speak, just based on the current reality. Based on comps, just based on, what the market is doing in health tech.
It's sure, based on comps. I think, in health tech, what tends to happen is you have to get a little bit more mature before you achieve those higher end multiples. But I think we're close to kind of meeting all of the criteria there, having a few more quarters where we report consistent, significant growth and those 75% gross and 45% EBITDA margins. So, I think even if the valuation isn't there now, it comes with time.
Yeah, but look, there's a couple of things that drive value. One is, they want the revenues, the maturation, but also the other thing is market validation and partnerships. It plays a role, which ties in to today's news, which I think the stock is up today, significantly. And this is based on this deal with, what is it? Cognizant, CTSH is the symbol.
Yeah.
I looked at their chart; they're doing very well. So tell us what this deal is. Why, why is the market excited? Why should they be excited? Why should maybe even more excited? Like, what is this all about? What are the economics?
So Cognizant is a $50 billion market cap company. They're a Fortune 500 company. I think they're Fortune 186, number 186. They're definitely a blue chip stock. 25% of their annual revenues come from healthcare, and they integrate with 650 different EMRs and EHRs, so electronic medical records and electronic health records. And 80% of Blue Cross Blue Shield's business and the billing through CMS goes through Cognizant. So they're just a healthcare space, but they're one of those, sort of quietly in the background, massively successful multi-billion-dollar multinationals. What they do tends to be more sort of system integration and data aggregation. So it's not kind of maybe consumer-facing, sort of sexier part of healthcare. So a lot of people won't have heard of them, but they're extremely well known and extremely well respected in the healthcare space. And so, partnering with them is an enormous deal for us. I think it's really a game changer. It's a key component of our strategy for this year, which is really to target those larger healthcare organizations. And having a blue chip stock like Cognizant, a company like that, really endorse us. And have us as their primary partner in RPM and CCM and BHI. That speaks volumes to the larger healthcare organizations who might otherwise have some concerns about working with a small Canadian company. I think that this really overcomes sort of any of the objections that, any larger client might have had in terms of, us being an unknown quantity. But beyond that, their capacity is going to allow us to scale very, very rapidly and to very large scale with some of these bigger clients that we're anticipating bringing on later this year. So I think, this is we certainly hit an inflection point last year in terms of, getting to profitability and, starting to get more and more of these contracts. But, I think we're definitely at another inflection point, and probably a much more significant one right now, where we're, really graduating from the scale of kind of smaller networks or individual physician practices, home health, et cetera, to these much larger clients, managed care organizations, health insurance plans, health systems, that include hospitals and community care providers. So I think that this is really where, kind of long term, you get into the dramatic jumps in valuation beyond where we are right now. So for us, this is a really game-changing announcement and partnership. And we're all internally very, very excited about it. And, Cognizant rarely issues press releases. So we're very pleased that they allowed us to disclose the news. And they've been already wonderful to work with. We're already responding to RFPs jointly for large systems. So it's an exciting partnership for us, definitely.
Okay, and so we're gonna touch on a couple of questions, but the main point today is we're gonna do like an update. We're gonna do like the full slideshow, like really give people the official company story, and then we're gonna come back with Q&A. But this is okay. So very impressive. So there's a couple really, I think it's important for investors to realize that you and Reliq have essentially delivered everything that you said you would do. Again, the premise of the next super stock program is we say, hey, these are companies that are this is the inflection point, and this is when all of a sudden everything is going to start snowballing and scaling, and this is when the stock takes off. And sure enough, that happened last year. All of a sudden, the contracts started rolling in. And by the way, it's also important to realize last year, 2021, was a horrible market for tech stocks. Teladoc, if you look at a lot of these stocks, they were like ski slopes. We're like, going down. And actually, Reliq, was counter trend to that whole thing. So imagine if Reliq held up strongly in that type of bear market for, disruptive innovation stocks. Imagine what it will do this year when all of a sudden things actually looks like they've bottomed out. So I think we're pretty much bottomed out in those innovator stocks, and so it could be extremely exciting. So in terms of so before we go to the slides, so I just want to also if we get the contracts and also the run rate, which is important, the 2 billion run rate. So this is it. This is, I think, massive deal. So the Cognizant. Okay, so I just want to get to a few questions. Maybe we can touch on a few questions, and then we'll do the slides, because I think it's such a game changer here. Okay, so are you? So AM87 is asking, are you expecting to sign large new clients through this partnership with Cognizant soon?
Yeah, I think we've talked in the past about how, our strategy is to move up to the larger clients. And certainly we've had, ongoing discussions with some of the larger clients who do take longer to convert, no question, for quite a while now. So I think, we're getting to the point where we're close to being able to get those deals signed. I think, the partnership with Cognizant is really kind of something that will help kind of tip things over the finish line much more quickly going forward with those larger clients, because it does give them the confidence that, if they say, well, we want to put on 40,000 patients next month, as an example, that's not not that anyone's necessarily specifically said that, but that we could do that and have care management up and running immediately and support them at any scale or pace of rollout. So,
okay. So this I guess this ties into this question from Damien. So is basically the idea of Cognizant, is this essentially, this allows you to scale?
Yeah. So we're not really hiring them. It's more of a partnership. They're very well known in healthcare for care management. So, we provide care management services ourselves. We have our own internal team. We'll continue to maintain that for the smaller clients. But for the larger clients, who might look at us and say, but I care management piece, and how are you going to hire all of those people? Because care management is definitely a human resource intensive component of the business. Who would say, how are you going to hire and train all of those people? And how do I know you're going to be able to retain them? And how do I know you're going to be able to scale as quickly as I need? Cognizant really answers all of those questions for them. And, they know Cognizant very well. Most large healthcare clients have worked with Cognizant in some capacity. So, they're very comfortable with them. They understand that they're a multi-billion-dollar multinational, that they can definitely support, contracts of any size. So no matter what your patient population, we'll be able to scale up the care management side. So, our software is inherently extremely scalable. Our onboarding process is largely automated. So again, very scalable, but where, you could understand clients having potential concerns is around care management, because we hire more care managers as we onboard more patients. And if we have a large client who wants to onboard a large number of patients and continue onboarding at a very high rate, we would have to hire quite a few care managers in a fairly short space of time. It's not that we couldn't do it, but I think this, gives even the largest organizations very good comfort that, we've partnered with someone who has a track record of providing care management and comparable services to 200 million patients. So there's really no scale that we would be going to that they couldn't support.
Okay, so really the bottom line is, I think the bottom line here is that, okay, last year was really where, you kind of proved out the model. You signed a bunch, you brought in a bunch of, contracts in which were, groups were, I think, 5,000, 10,000, 30,000 patients, whatever the numbers are. But this is the year 2022. Now with this partnership with Cognizant, we could see, contracts for, 1 million patients.
That's certainly our goal. I mean, we've always said that the platform was built to support millions and millions of patients at the same time. And certainly, we're talking to much larger organizations than we were a year ago. And, hopefully we'll be able to get some of those accounts across the finish line shortly. I think.
How shortly? When can we see?
Well, that we can't. We can't disclose insider information, but I would say keep a close eye on us.
It's not insider. So there's a couple hundred people watching right now. So it's public.
That's still selective disclosure.
Selective disclosure.
You're not the one who'd go to jail. That's me. And I've seen Elizabeth Holmes and the Theranos trial. Cautionary tale to all of us. So, I think keep a close eye on us.
Right.
You're not likely to go a long time without getting meaningful news from us because of the phase we're at in terms of our growth. So,
okay, so meaningful time. I'm gonna take that to mean first quarter of 22 that we could see something.
Well, you never can say in this healthcare market, particularly with crazy variants popping up like Omicron, but I think we're in a very good position going forward through 2022. And I know everyone always wants everything to happen instantaneously, and we certainly try to deliver very quickly. But sometimes things take a little bit longer. I think what you really need to look at with this company is the long-term value here is insane. I mean, we have a huge target market. We've got a first mover advantage. I think that's really been validated that we are, kind of best in class in the space by this partnership with Cognizant. I mean, the last time they worked with a company that did RPM, it was Microsoft and Philips, sort of 10, 15 years ago when they had a solution for RPM. They no longer have that.
RPM is
what you do, remote patient monitoring. It's what our software does. So, I think Cognizant could choose to work with anyone they want. They don't generally choose to work with tiny little companies. So I think the fact that they are working with us is definitely an endorsement of, the uniqueness of our platform, how well it meets the market needs, and how well they think it would appeal to their clients, who are, very, very large healthcare organizations.
Okay. No, so this is, I think today's news is, I don't know if it's a game changer, like, oh my God, this is like, but it puts the company into like, this is, I mean, maybe 6 months from now, a year from now, people will say, okay, this was the event that really got them to the possibility of doing these much larger contracts. So the game changer will be that large contract. When I don't
think it'll take 6 months to a year, but I don't think it'll take that long. But I think this definitely is the inflection point that, when you look back, a year or two from now, and you see, the charts, you'll see there was an initial sort of small inflection point, and then a much more significant one, followed by really significant growth.
Okay. No, I think it's going to be what's going to get investors really excited is going to be when they see that, the first big contract announced, which is going to be that one of these major deals, and they say, okay, this company's for real. I mean, this is.
I mean, I do think, part of our capital market strategy, obviously, is to get more U.S. investors and more U.S. institutions, because it just, eliminates a lot of the volatility in the stock, and it does, help with a lot of other things, like, moving up to the NASDAQ. I think this partnership with Cognizant really will help a lot in terms of, giving institutional investors, more validation and expanding their ability to do, really good due diligence. So I think this is a key component, not just of our go-to-market strategy, but it also will definitely help in terms of the capital market side of the business.
Okay. Lisa, before we dive into the questions, I think probably one question that might be in the back of people's mind is, okay, is the company potentially going to do a financing? I mean, right now, if you're doing $2 million run rate, how's your financial situation? Like, are there any plans to do any kind of capital raise?
No, we don't have any plans to do a capital raise. So, I think we've talked about this before, but, we're generating revenue. We'll be cash flow positive this quarter. So I don't really think there's a need. If, that changes for some reason, for, reasons that were very good news. So if we needed to service a very large client for some reason, a little capital, but it wouldn't be significant. So, we're definitely not anticipating any dilution from financing going forward.
Okay, so with that said, let's get the slides, and I'll disappear. I'll come back for the Q&A. We got a bunch of questions people are asking here.
All right, so this is just a very brief, I'm not going to go through the full corporate slide deck, since most of you are probably familiar with the story, but I do want to just kind of quickly hit on some of the milestones that we achieved in 2021, and then share our outlook for 2022. So forward-looking statement disclaimer, review at your leisure. So just as a reminder, and if there's anyone new to the story on the live stream, we're a rapidly growing, profitable global telemedicine healthcare technology company. We've developed innovative virtual care software as a service solutions, and they're aimed at the multi-billion-dollar healthcare market in the U.S., specifically at the market for chronic disease patients. Our platform is intended to benefit all of the constituents of the healthcare system, from payers to clinicians to patients, to obviously Reliq as well. And we provide comprehensive turnkey solutions to clinicians that allow them to really rapidly roll out new virtual care solutions that are billable. And we receive recurring revenue from subscriptions. And we are experiencing rapid organic growth that's fueled by industry trends, as well as to some extent by some of the pressures on hospitals and community care providers due to the pandemic. We have strong margins of roughly 75% gross and 45% EBITDA. And we expect to generate over 40 million in revenue in the current calendar year, so calendar year 2022. And brief overview of the benefits. So for patients who are on our platform, they have significantly better health outcomes when they're on iUGO care than when they're left to manage their chronic diseases on their own in the home. And as a result, we see a significant reduction in hospitalizations for this patient population. And what that translates to for the patients and for their families is a significant improvement in quality of life. For providers or clinicians, using our platform creates new revenue streams for them. And these are very significant revenue streams. They're very high profit, and the average physician practice can make over $1 million in new revenue at over 75% margin by implementing iUGO care. So it's a really very compelling value proposition for clinicians from the financial perspective. And the other advantage to clinicians is that Medicare and Medicaid have implemented penalties for clinicians whose patients are hospitalized more than the average Medicare or Medicaid patient. So there's both, the carrot of these new reimbursements, but there's also the stick of financial penalties. So we address, that from both sides. And the average practice can generate over $372 per patient per month by deploying iUGO care. And again, we're only charging between $40 per patient per month. And so it's a very high profit margin revenue stream for those clinicians. Excuse me. In the first half of 2021, looking back on last year, our business was definitely constrained by rampant COVID-19. But the vaccine rollout led to a really significant fundamental shift in U.S. healthcare in the second half of 2021. So as we'd said all last year, the bulk of our growth would take place in the second half of 2021. And that's certainly how that year panned out. Excuse me. And what we found was that clinicians in the second half of the year were able to turn their focus away from just the urgent care focused on COVID patients to more of the proactive care for their chronic disease patients who had really kind of been left to languish during the pandemic and definitely were in need of attention. So, there's been much more of a shift to a focus on preventative proactive care. At the same time, CMS has increased reimbursement levels for virtual care for chronic disease patients that's aimed at preventing hospitalizations. So when we started in 2018, the average reimbursement for a clinician was around $59 per patient per month. And at the beginning of 2021, rather, it was around $315 per patient per month. By the end of the year, it was $372. And in some states like California, it was over $400 per patient per month. So, Medicare and Medicaid have really signaled to the market, and they've, said explicitly that their intent is to continue to really significantly fund these programs because they've demonstrated for themselves, with their data, which is very extensive. They've got tens of millions, dozens of millions of patients, that these programs really do prevent hospitalizations and therefore reduce costs for Medicare and Medicaid, and can reduce costs by up to 5%. Excuse me. In 2021, we saw a dramatic increase in inbound sales from referrals. What we typically find now is that when we deploy with a given physician practice or home health agency in a community, about 2 months later, after they've started collecting their reimbursements from Medicare and Medicaid, and they're able to see that, yes, their patients are having better health outcomes, then all of a sudden we get a call from 6 of their colleagues at different practices saying, when can you sign me up? When can we get started? Apologies. So in 2021, we expanded into California, which is the most populous state in the US, more populous than Canada as a country. And we also expanded into Puerto Rico and the US Virgin Islands. We expanded and enhanced our platform so that we could provide not just remote patient monitoring and chronic care management, but behavioral health integration, principal care management, really a suite of services. And we're able to support now orthopedic patients, nephrology, kidney patients, HIV, and hospice patients, so patients at the end of life. We've signed contracts with clients that provide a pipeline of over 200,000 patients. And those are not just contracts, those are implementation plans. We have about 500,000 patients under the current contracts, but with the pandemic, we haven't gotten to implementation plans with every client. So with those that we have a clear path to onboard 200,000 patients by the middle of 2023. And that translates to about $120 million in annual revenue at full deployment. And that's at an average revenue of $40 US per patient per month. For the quarter that we most recently filed financials for, which would be the quarter ending September 30th, 2021, and we increased sales quarter over quarter by 192% relative to the preceding quarter to 1.6 million at a gross margin of 72%, so really close to our target. And we achieved positive adjusted EBITDA. I don't, in my own mind, consider non-cash expenses to be relevant to a business, because really what matters is, do I have the money to cover my expenses? So, the positive adjusted EBITDA is a very meaningful metric for us. So our outlook for 2022, we expect to be cash flow positive this quarter. We are looking to uplist to the NASDAQ at some point in 2022, and currently targeting sort of the second half of the year, but certainly options to bring that forward if it was appropriate. And we'll be leveraging the new CMS billing codes for 2022. So these are cover something called remote therapeutic monitoring, which is essentially just remote monitoring for a new group of patients. And that would include patients with musculoskeletal system issues and patients with asthma. So it expands our patient population pretty significantly from that, original target of roughly 37 million Medicare and Medicaid patients to over 50 million Medicare and Medicaid patients. And certainly as we look to start working with insurance plans, that expands the market, very significantly into the privately insured patients as well. And our strategy for 2022 is definitely to focus on securing the large-scale clients, such as managed care organizations and health systems, large health systems, and health insurance plans. And we will expect to achieve our target margins of 75% gross and 45% EBITDA, which are very compelling margins in the healthcare space. If you look at, Teladoc and Livongo, they have single-digit EBITDA margins, and which leaves a business very vulnerable to changes in market conditions. And we expect to generate revenues of 40 million this year, and we expect to achieve all of our milestones without a capital raise. I know you've all seen this growth forecast before, but I'll just kind of reiterate. We have updated our guidance for 2022. We did that at the end of 2021. And so our forecasted guidance for this calendar year is 40 million. And certainly every quarter we'll revisit that number and adjust as needed. But I think, all signs point to very positive developments there. If there are any updates, we will update guidance for the following years as we get further into 2022 and have more sort of data to point to when people ask, for the origin of our projections for the future years. So for now, we're really focused on that updated guidance for 2022. And again, as I say, we'll update that every quarter going forward. And so that's just a brief overview of where we were and where we think we're going this year. And now I can go back to Jack and take any questions.
Okay. Okay, let's get into some questions. So the big takeaway is 40. Okay, so the projection is for $40 million in revenues in 22 this year. We're in 22 now. So in actual revenues of 40 million. Next year, and again, the market is forward looking, so people are already looking. They already forgot what you did last week. They want to know next year. They're going to start anticipating. I think the market's going to start pricing in next year, probably in a few months. If you can hit a couple of these big contracts, which we're waiting for these big million patients or whatever these mega contracts, people are going to that 120 million revenue is going to really crystallize in people's heads, and that would mean that could be based on the numbers, $5 billion valuation. I mean, it could be $10 a share stock price. I mean, there's really a path, based on market comps. Even this year though, if you could do 40 million this year, again, you're at 24 million run rate now, so it shouldn't be too difficult to ramp up based on kind of the rate you're moving at. It should be pretty reasonable. So definitely things are looking really good for the stock. Okay, let's get into a couple of questions here. Okay. Do you, Steve asking, do you anticipate any acquisitions?
No, we've looked since I started with Reliq, which will be 5 years ago next week or the week after. We've been looking in the market for potential acquisitions. We just really don't see anything at this point that would truly benefit the business. I think with acquisitions, you do need to be really careful. I've been through acquisitions before, and it is a real challenge to a business to integrate a new company. And there have to be really clear synergies, and you have to, even Teladoc and Livongo, where I think the synergies were fairly clear. I wouldn't say that integration has gone smoothly or quickly. And so you have to really consider, the opportunity of taking your eye off your primary business goals to integrate with an acquisition. And, where something would make sense would be if, there was someone we could acquire who already had a bunch of remote patient monitoring patients. And, so we could add that, revenue instantly to our top line. But the reality is, one of the, I guess, downsides of being sort of first to market or, establishing the gold standard for care in our space is that there isn't anybody else out there who's doing what we're doing where we could buy them, and it would help us grow the business. Right now, the few tiny competitors we see in the market who are doing, some component of what we do, we just go into their clients and tell them what we can do, and they switch over. So there's no cost to us to acquire their clients. So it wouldn't make any sense to buy their businesses and pay, a premium for those clients when we can acquire them with, 20 minutes worth of conversation. So.
Okay. So, some people were asking, okay, that, there was a bunch of comments saying that, okay, well, Reliq saying that they could scale, whatever. I think this Nedzat is kind of nails it on the head. We're saying that, okay, you can scale to a certain degree, but having this partner is really what you need to get those massive contracts, the million patient.
I mean, we've talked about this before. I think there's no scaling. We could scale to any size of client without any issues. But I think that, what you face as a company, not just in the regular market, but in the capital markets as well, is perception is everything. And so I think for large clients who are, healthcare is an incredibly conservative market, and the larger the client is, the more conservative they are. So I think for those kinds of companies, you've probably heard the expression, nobody ever got fired for speccing RPM or IBM. IBM, sorry. I think that kind of gives us that, clear association that will give those healthcare clients comfort and working with us. And, it's the kind of thing where you can go to your board and say, well, they're working with Cognizant, and Cognizant is going to help on the care management side. And, Cognizant has assured us that they're going to be able to scale to the patient numbers we have. I mean, that kind of thing in healthcare makes a huge difference. We can tell them as many times as we want that, we have scaled up very quickly already, and we can scale to any level. It's not an issue. But the credibility of a Cognizant versus a Reliq, it's a pretty big difference. So, these kinds of partnerships in healthcare can really make or break a company, and having this kind of affiliation, this kind of endorsement is huge for us.
Yeah, no, I think a lot of investors, retail investors may not realize, like, again, in healthcare space, like you say, it's very conservative, and nobody's going to, give you, a $50 million contract unless they really have like incredible faith. And I mean, again, it's, Reliq is a small company, but with this partnership with Cognizant behind you, that gives, that basically makes it very easy for everybody to make the decision. Like that, no one's going to get fired for doing it, because they have, they can say it's Cognizant.
Yeah, it really lets us punch above our weight,
Right.
and then get to our target weight as a result much faster. So I think it's certainly the dream of every smaller healthcare company to have an alignment with a really well-known company in the healthcare space, and that's a real validation. So this is
okay.
very
This accelerates. I think, like what Dwight is saying, this basically accelerates everything that you're doing.
It definitely does. It definitely
gasoline on a flame here. Okay, Gary's asking, will this agreement accelerate the onboarding process with the backlog? Does this have any impact?
I mean, it may. I think it's more likely that it's going to impact the kinds of clients that we can acquire, and the pace at which those new clients will onboard. And a lot of the clients that we have now, who their implementation plans are a little bit maybe drawn out compared to what our shareholders would like to see. A lot of that's a function of the pandemic. So, if you've got a long-term care facility network, and you're still really grappling with residents getting sick and staffing shortages, and it's hard to kind of look at this new component of care that you're going to offer through our platform. For the most part, our bottleneck is not so much around any of our own capacity or capabilities, or any concerns from those clients about our ability to scale up. It's more sort of been pandemic related. But I think where this is going to make a huge difference is going forward. If we get larger clients, we'll be able to set much more aggressive schedules with them in terms of onboarding larger numbers much faster. And I think they'll be very comfortable with that, given that Cognizant will be supporting some of the manpower intensive aspects of the deployment, which is really the care management piece.
Okay. Interesting question. Josh is saying, will this new partnership make you a takeover target now? Because now, the market recognizes, okay, you're at this run rate, you have this capability. Essentially, now you have the capability to do these, large scale contracts. Could Reliq be a takeover at, I don't know, $20 a share?
Yeah, I mean, I think, that's the thing, is these takeovers, even when they happen, and there's certainly always been a trend of consolidation in the healthcare industry, but, when these takeovers happen, they take time. They're not overnight. So I think we have lots of time left to grow to a much more significant valuation before we have to worry about someone, acquiring us at a bargain basement price. I would also say that most of the companies that I think, would look at a Reliq and say, that would fit in nicely with, what we do. So either the big US health insurance plans, or even someone, similar to Cognizant as systems integrator, something like that. Those companies really aren't set up to value an acquisition when the company's worth less than $1 billion. So I think, they'd need us to get to at least $1 billion valuation. And I think in this space, the nice thing is, particularly given that we're not, one of many companies doing what we do, we really do have that, gold standard first to market advantage. I think if one company was interested in potential takeover, we'd probably end up with quite a few suitors. And that's the kind of thing that tends to deliver really good shareholder value. So I don't think it's something that's likely to happen in the near term. I am aware that is a possibility, down the road.
Nothing
but
below
our intent
$20
is,
a share. Lisa, nothing below $20 a share.
Sure. Our intent is to build this business as its own self-sustaining business, and to, long-term be our own, independent company. But, I recognize the reality that there is a trend to consolidation in healthcare, and that a takeover is always a possibility. But I think, we're well past the point where I would worry that we'd be scooped up at a low valuation. I think we're growing fast enough now, and these things take long enough that we could definitely ensure that it would be a very high value transaction for our shareholders if that were ever to take place.
$20 minimum.
All right.
If it's now.
I heard
you. We got okay. So Toby's asking a question. Okay, so this is interesting. Okay, so he's basically saying that we said there's not going to be a raise, but I think at one point you said, well, you might do a small raise if you sign this very large contract where you might want to have a little extra capital on hand. Okay. So can you?
Yeah, no, and I understand, Toby. That's a very good question. So, the reality is we don't need the capital to be able to service a large client. The other side of the reality, though, is some of the large clients may say, we feel more comfortable if you just had a little bit more cushion on your balance sheet. So if we had to do a $3 to $5 million raise very quickly to,
that's nothing.
To make a very large client happy, that's something I'd be willing to do. But we're not going to do a raise just for a raise's sake, and we don't need to do a raise to cover our operational expenses. So I think, it's the kind of thing where if we were doing a raise, we'd be in a very, very strong position, and it would be a very small raise just to provide a little cushion on the balance sheet.
Yeah, I mean, let's say if you raised, even if you did like 5 million, that's only like what it'll be 2 million, let's call it 2 million shares roughly, and that's like 1% of, that's nothing. It's like that's one day's volume.
Yeah, I mean, it would be minimal dilution, and
Yeah.
it's not as if that money, comes into the company and then evaporates. I mean, that money immediately adds to the balance sheet and therefore, enhances our valuation. But I mean, this is all academic. We don't have a raise planned. I'm just, I try to be as transparent as I can. So
Yeah.
I'm trying to give you all of the possible outcomes
Right.
down the road.
Yeah. Give them kind of like, because people, for some reason, investors are paranoid about raises, dilution. But even at this, it's so. This is bottom line is if it is, it will be very small, and it's not going to happen. And the only time it would happen is if you had this very very large contract, and which would be super accrued. And this would be like nothing. Yeah. Okay, so let's see here. Let me see. We have a couple of There's a couple of questions out there, basically along the lines of, okay, well, the company's had some stumbles in the past years ago.
Yes,
it's the same question. How do we know that it's not going to happen again? It's the same. It's like the same. It's the same question.
Yeah. I mean, I think for one thing, those stumbles were excruciatingly painful for me. So I'm not going to live through something like that twice. So we've put just a ton of different mechanisms in place to ensure that we don't end up in similar situations. So the big issue that we had a few years ago, back in 2018, was the billing codes were new. Some of our clients got a little overly aggressive about onboarding patients who, in fairness to our clients, they were trying to help people who needed help. And I think at the time, the reimbursement criteria weren't very clear. Medicare and Medicaid, to their credit, have really gone out of their way over the last few years to not only clarify the criteria, but to make it easier for people to qualify for remote patient monitoring, behavioral health integration. They've introduced billing codes for new, completely new kinds of care. And they've made the whole reimbursement process much easier. But what we've done is taken on a lot of the screening responsibility ourselves, which other companies don't do. So, where in 2018, we left it up to the clients to determine that patients were eligible. Now, before we add a patient to our platform, we run them through the Medicare and Medicaid databases. We secure an electronic pre-authorization from Medicare and Medicaid. And what that does is say that for that patient, if the clinician delivers the services, which is mostly down to us, we're able to ensure that the patient collects at least 15 readings a month or 16 readings a month, which is what's required to get paid. And we really handle all of that, but we know that clinician is guaranteed going to get paid for that patient. We also changed all of our contracts so that instead of clients being able to wait until Medicare and Medicaid to reimburse them, they are obligated to pay us even before Medicare and Medicaid may have reimbursed them. So we have eliminated all of the risks that we had when we were a small company starting out. And in fairness to us, I will say that, we weren't the only company who got caught in that first year of confusion with Medicare and Medicaid. And it was a very difficult year for any company that was in that space and, remote monitoring, virtual care. But, we fought through that, and, we really did everything you could possibly do to ensure that going forward, there's no risk that, patients won't be eligible or we won't get paid. So, we've de-risked that component of the business, far more than any other company in the space ever has. And we've taken over things like, automatically, electronically submitting claims to Medicare and Medicaid on behalf of our clients. And so we have a lot more control over the process than we ever did before. And I think, let's be honest, a company like Cognizant does a lot of due diligence before they get involved with any partner in any capacity. So, I think if we, we're playing a shell game here and, didn't have a real business, you'd never get a company like that to touch you, especially with our history. I mean, they have Google too. So, they understand that we had, some issues several years ago. But I think the fact that we've, continued on and that we have been able to make tremendous inroads with, really large patient populations, and we have quite a few U.S. clients, and they all speak extremely highly of us. And I think people understand that sometimes there are stumbles in healthcare, as in any industry. But
well, you know what it is. To be sure, also, when Reliq started, you were a pioneer in a space. It was like essentially a new industry, and the billing codes were not there. It's almost like Amazon. Getting started. I don't know, when did Amazon, I think, started in, 1998, whatever it was. Like, the internet was just like AOL, or 97, whatever the year, it was like 97. It was like, people weren't comfortable giving credit cards over online. Most people didn't have internet. It was just like, it wasn't there. And then all of a sudden, 2 years later, it was a whole different world where, it's perfectly normal to give a credit card to, just put it into the, and it was, everything was, and the shipping, everything with the shipping started working. I mean, they had stumbles early on. People forgot already. But, it was a couple
and I mean, we have a completely different team now, right? And at the end of 2018, 2019, I stripped us back to just myself, one of the technical founders, and our chief medical officer, and then rebuilt the team from the ground up so that we wouldn't have any issues with people who were, more interested in their own personal gain than in, delivering value to shareholders. And we have a lot more oversight. And, we've added, we went from a tier 2, let's say, auditor to KPMG. We've really done everything we can to put in place, very mature systems that would be suitable for a company that is, ultimately NASDAQ listed, and to provide a lot more transparency to, everyone, myself specifically included. I have a very clear line of sight into everything that's going on with the business. I closed the Vancouver office and moved everything to Hamilton, which is where I'm based. So, I kind of inherited parts of this company, and what we have now, I built myself, and from a perspective of once bitten, twice shy kind of thing. So we've been very, very cautious about our hires, and we're very cautious about the way that we operate the business internally. And there's just a tremendous amount of oversight and visibility within the company. So I think we're just a very, very different company than we were when we started.
No, it's interesting because, like, right now, it's basically, essentially the business has been really, de-risked for the most part. Like, like in any business, when it starts off, especially when it's like in a very innovative space, there's always stumbles early on. I mean, even, Airbnb, their original business was, I think, selling cereal. They're selling it. I mean, there was some wacky thing, and it didn't work. Then they pivoted, and all of a sudden they started. But they went through a couple of iterations. The group. So. So same thing here. It's like, there was a couple of stumbles early on, but the crazy thing is, in the microcap space, like, a lot of people, they never forget. This is, especially, you have a lot of, people online that, I don't want to use the word trolls, but you have on message boards, you definitely have trolls on message boards who, like, they owned the stock 5 years ago or something. They come back, they don't even own the stock, and they'll say, oh, this is this. But one of the key things, again, with Cognizant, is having them as a partner. Again, like you said, they do a significant amount of due diligence, because ultimately they're the ones that are essentially, they're going to be responsible if anything goes wrong. I mean, for the most,
even when we switched auditors, KPMG did about 8 months of due diligence, full criminal background checks on everyone on the team. I mean, really a lot of extensive due diligence. And, with our audits, they basically contact every single customer. Not basically, they contact every single customer. So, we have confirmation letters that come in around the audit from every single customer. So it's not, it's a very different business in terms of the accountability and transparency. So, yeah, it's a very, very different business from what we were back in 2018.
I mean, I think maybe if somebody can read between the lines, is essentially you're getting the company NASDAQ ready. If you have KPMG, the company's essentially in the next 6 months. I don't think there's any hurry. Let it happen organically. No reverse splits. Let it happen. Let the stock go to $5, $6 organically, and then whatever. Let's. Okay, so question, Haifa says, can you publish the number of patients onboarded and back on a monthly or quarterly basis?
Yeah, I mean, that's definitely not something we would do monthly, because what you see with onboarding is, December might be slow, and then January might be, big month, or November might be slow and December is a big month. And every time you announce that, people are bitterly disappointed by 1 month, and then they get super excited about the next month, and then they, that sets a too high a bar for the following month, so that creates too much volatility. And we've discussed it on a quarterly basis. I mean, in some respects, the patient numbers are kind of a key metric for us to not necessarily share with competitors. And in particular, at the moment, as we're trying to attract some of these larger customers, we don't necessarily want to draw attention to having, 40,000 patients as opposed to 400,000 patients. So, I think as we go forward, we'll probably be talking a lot more about patient numbers. But for now, what has made sense for us as a business and what, shareholders really should be focused on is revenue. So when we provide projections around revenue and when we publish what revenues were for preceding quarters, that's the only metric that matters. Your valuation is going to be based on, how much money you're getting, regardless of how many people you're getting that money from. And I know people feel more comfortable if they can kind of model things themselves, but the reality is, and I am saying this as someone with a PhD in engineering, so I'm a little biased about modeling, but models are only good as your inputs, and no one outside the company is ever going to have access to all of the inputs to create a really viable model. So, worrying about things like patient numbers, that's not going to tell you anything that we're not already telling you when we talk about revenues. So, sometimes there are valid reasons from a competitive perspective and market volatility management perspective to not share every single piece of data. Apple, they no longer disclose things like which, iPhone generated which, pool of revenue, and sometimes
which supplier is supplying the chip. Yeah, there's some things.
Sometimes there are corporate decisions, and you don't necessarily have to like them. But I think what you do need to really focus on is, is the company delivering? Does it seem to be keeping its promises? And what is it forecasting in terms of actual revenue? Because, we've seen with Netflix, you can have a whole bunch of subscribers, but then it turns out that a bunch of them were those free trials. So they weren't actually revenue generating. So, you really want to focus on what the company's projecting from a revenue perspective.
Okay. So let's get to a couple more questions. One of the questions I think we'll address after the discussion. I think there's a lot of people who are still not clear exactly what is Cognizant, like, in other words, what is Cognizant doing? What is this all about?
Sure.
We have to really simplify this, but first I want to just cover this question. Does your $40 million forecast, 40 million revenues forecast, 22, does that include these large clients?
No.
Okay, it does not include any of these big clients.
No.
So, or will you have to up your guidance as these large clients are announced?
Well, that would be kind of a logical assumption. We provide guidance based on contracts that we've already announced, because that, is something that we can sort of very clearly point to as how we're going to get to that number. So as we announce new contracts, we will update guidance.
Okay, so bottom line, this 40 million revenues forecast for this year, it does not include any of these, like, let's call these like, mega clients. This is based on just the existing type of
announced, existing and announced.
Normal stuff. Okay. Very, very good. Okay, so let's get into the big explanation. So let's explain. Okay, Lisa, just let's break it down in plain English. Exactly what is this partnership? What is Cognizant doing?
So, we have a care management team.
How are they making money? What's in it for them?
Mm-hmm. So, we have a care management team. So what our care managers do is kind of the almost administrative side of what you need to do for these billing codes. So they'll act as an extension of the physician's office. They'll do things like track patients' adherence. They'll update care plans. They can actually reach out to clients directly if you have a patient who's not collecting their results, or who needs to be, trained on a new monitoring device, that kind of thing. So we usually hire medical assistants who are very capable healthcare associates, and they're the ones who typically perform care management, but they're also a very inexpensive resource. So Cognizant has a whole care management unit, so they'll be able to supply care managers. So instead of us paying internal resources, we'll allocate the same amount of money to basically subcontract that to Cognizant. So it does not hurt our margins. If anything, as we scale up, it will improve margins beyond what we could do with our own internal team. And certainly, obviously, there's the credibility of it being Cognizant who's going to do your care management. So with the larger clients, we expect that they'll probably want to use Cognizant for care management. With smaller clients, they'll probably stick with our own care management team. And that's fine for us. I mean, basically it all is revenue that will come through us, and our margins are the same or even potentially better for clients where Cognizant is our care management subcontractor instead of us having our own contractors that we use for care management. Does that answer that
Yeah,
question?
I mean, okay, and I'll give an example. It's basically almost like, you know, the difference between, you know, running a business, like, you know, if you have an online business, running it, the whole thing like on your own server, like you actually have a server in your office, or you use, you know, Amazon Cloud, you know, Amazon, you know, AWS, Amazon Cloud,
Web Services,
which can scale, you know, ad infinitum. So, and if you're going to take on, let's say, I don't know, whatever large contract, whatever it is, you know, anybody who, you know, who's they're going to want to know, can you actually deliver? Can you scale? And, you know, they don't want to, you know, people, you know, they don't want to rely on you having, you know, a tech person having 5 servers. They'd rather say, okay, if you have a deal with Amazon, if they know that it's going to be on the Amazon cloud, no problem, no worries, because these guys.
And we are hosted on Amazon Web Services for exactly that reason. It's another thing that gives healthcare customers comfort. I think another component of that question is what's in it for Cognizant. Well, what's in it for Cognizant is, you know, as we scale up to these larger clients, and I mean, keep in mind, this is a company that's doing, I think their revenue last year was $16 to $20 billion, so US. So for us to be of interest to them, you know, they have to have an expectation that there's going to be significant revenue coming to them through our contracts. And since we're not paying any more to them than we would pay to our own care managers, you know, for them to get into the, you know, tens to hundreds of millions, they're expecting us to end up with very large clients and a very large patient base. So, you know, what's in it for them is real revenue. And I think, you know, what's in it for us certainly is that, you know, they've done the due diligence and, you know, they have their own network, you know, so they have some visibility into potential, you know, business opportunities that we might, you know, not have on our own. So, you know, I think they're very excited about the revenue potential, and what that comes down to is clients and patients.
Okay. Toby's asking, will you break down the SaaS versus device revenue going forward?
Yeah, so going forward, the bulk of our revenue will always be from the software and services, so the care management and the software subscriptions. Devices are something that, you know, in the past we have held inventory and sold to clients. Going forward, we'll only do that for select clients, you know, larger groups, and we find particularly the managed care organizations want us to purchase the hardware and you know, then deliver it to them. It's not something where we're going to need a lot of working capital to do that. You know, we'll be able to acquire the inventory just in time from the suppliers and deliver it to the customer, and not pay our suppliers until the customer has paid us. So, you know, we've got relationships in place around that, but it will be a one-off. So, you know, going forward, we don't want, when I talk about run rate, the reason I talk about run rate so much is that that's based on subscriptions. So that's based on consistent, predictable, recurring revenue from subscriptions, whereas hardware sales are going to be a one-off going forward. So, you know, if we had a month where, say, we had 5 million in hardware sales, I don't want that, you know, included in the run rate going forward, because it would be misleading. But where you should really be valuing the company is looking at that run rate, because even if we haven't collected that revenue or even necessarily, you know, recognized it that particular month, the run rate is what's ultimately going to dictate the valuation of this company, because hardware companies typically have, you know, fairly low margins and not very high valuations, but software as a service companies, and, you know, the valuations are very compelling, the multiples are very high, and that's all based on the recurring revenue from subscription. So, you know, we'll break that out, absolutely, but we should expect that there will be fewer hardware sales. They may be larger orders, but they'll be one-offs, as I say. They won't be something that's, you know, sort of frequent or all that predictable, really.
So, okay, so the $24 million run rate that you're at right now, this is subscriptions. This is SaaS, pure SaaS revenues.
That's right. Yeah.
Okay. And okay, so again, I want to recap, because I think the big takeaway for the whole investment story comes down to this: is that you know, the stock has right now a clear path to, $10, because, right, you're going to be doing, $40 million run rate this year. So again, the market is paying crazy multiples for the health tech space. SaaS HealthTech, 50x very possible, okay, which is $2 billion. Or next year at 2023, $120 million run rate. That could only be, let's say it's only a 20x multiple or whatever it is. So you're still going to have a 2.5 billion divided by 200 million shares is roughly $10 a share, if I did my math correctly. So basically, this is the path to $10. And again, the market is forward looking. So it's, the way things are valued is based on what people think it's going to be a year from now, not where it's at right now. Because I know this always happens, with people, because you may have great news, like Lisa, what may happen is you may have great news in a few months, and then the stock will drop that day. And people say, why is it dropping? Well, it's priced in kind of, it's forward looking. So it's one of those things. Okay, so let's see if we can address a few more questions, and then we'll wrap up this. Okay, so how is the collection of receivables coming along?
Yes, yep. So that's picked up very nicely. So we had some good pre-Christmas presents of revenue coming in, and as we'd said, I think before, we expect all of those aging receivables to be collected by the end of March. So this will be a good quarter for cleaning that up on our financial statements and bringing in that outstanding revenue. I saw a whole bunch of questions flash by, but they all went too fast.
I'm going to pull up. I just wanted to let people know that we're going to go through the question. Okay, so how did this partnership with Cognizant come about? Did they reach out to Reliq or vice versa?
Yeah, so we've talked before, I think, about our U.S. business development team, who are former C-suite level executives from a variety of different organizations in the healthcare space, and this partnership really arose through one of them about maybe 15 months ago even. They kind of mentioned to Cognizant, who they knew had worked with Microsoft and Philips years previously on remote patient monitoring, and Cognizant doesn't have a remote patient monitoring or behavioral health integration or chronic care management solution internally as part of their portfolio, but it's certainly something that will be key to servicing their healthcare clients, going forward, needing that full, connected care ecosystem. So we started conversations with them. It's a very large organization, so it takes a little while to kind of filter through to the right people, but we're now working directly with the head of the healthcare business unit, which is responsible for 25% of all of Cognizant's revenue. We definitely got up to the right people, and they're very keen to grow the healthcare business. I think if you look at Cognizant's revenue relative to its valuation, I think their multiples not as high as it could and probably should be, and so they're definitely looking to healthcare as a division that can represent some really significant growth and innovation for them going forward, and therefore that's key to their own capital market strategy. So things kind of aligned over the last few months where, Cognizant started to see some real opportunities. And as I said, we've jointly responded to a few RFPs with them. So, I think the timing was right. And I think we also got to a point where we had enough data from clients that, they could really do fulsome due diligence and assure themselves that this was a platform and a company that would make sense to partner with.
Okay. Jeremy's asking, will Cognizant help in your marketing?
We haven't specifically discussed that with them, other than to say that, the press release had to be approved by both their marketing and legal teams, as well as their management team. So certainly their marketing team is already involved. There's no question that, they will be of great value to us going forward in terms of reaching out to customers. At the same time, I will say that there's not a lot of marketing that you do specifically in healthcare. It's more, kind of direct customer outreach to these larger groups. You're not going to ever get a client by going to a conference or, advertising in a trade publication. We certainly will go to select conferences going forward. But, there's not a lot of marketing that works in healthcare. Healthcare customers are definitely skeptics. And so they like to buy by reference. And so you really just kind of have to start out at the bottom working with small clients, build a reputation, generate that data that shows yes, your clients get reimbursed, and yes, you do keep patients out of hospital, and then work up to these partnerships that give you the credibility and the sort of warm introductions that make a huge difference in terms of scaling the business.
Okay, so I think we've covered everything. So bottom line is the path to $12 is becoming more and more clear as you know, as 2022 unfolds.
Yep, I won't ever try to predict the market, but I will say, you know, we're building a real company here that has, you know, huge potential market opportunity, and we've got, you know, really key pieces now in place like this partnership. So, you know, I think we're definitely on the right track, and we're very excited about 2022.
Okay, and also, you know, from the investor's perspective, I think the market is now bottoming out for the, you know, tech innovation, you know, disruptive innovation stocks. Teladoc is about, so once these things start to turn, you know, this was you know, a headwind for the last year for Reliq, and now this is going to lift all, and so I think we're going to see some really exciting things in 22 as, you know, these stocks start lifting again, and you know, people are going to, you know, it's going to be very exciting. Okay, Lisa, thank you again. Great catching up with you. And oh, I'm sorry, one more question, one last question. I forgot my favorite. This AM8, thank you for reminding me. This is a class. Lisa, what, I'm sure we're going to catch up with you earlier, but what can we expect in the next 30 days? Actually, let's just say the first 60 days between now and February. Between now
that's a Jack question for sure. I think that's your pseudonym, that AM871. You know, we can't obviously offer any specifics, but you know, obviously this is a period of growth for us, and I think that there'll be lots of positive news going forward, and you're just going to have to stay tuned.
All right, fantastic. Again, on that note, Lisa, thank you, and thank you everybody for joining our live stream. We'll see you.
Thank you very much, everyone.